This is part 2 of the lecture on the analysis of bonds with embedded options. And what we're going to do is talk about valuing callable and puttable bonds. If you're an investor in a call option, there's a disadvantage because you're subject to reinvestment risk. The bond can be called away from you, and then you need to reinvest the funds, and the bonds are likely to be called away from you in low interest environments, which means your reinvestment opportunities are going to be quite low as well. The call option also reduces the price appreciation potential. When you think about the low interest rates, in most cases the bond values go up, but in a callable bond, because of the likelihood of being called, the price appreciation will not be as much as it would be for a non-callable bond. In terms of compensation for this risk, the bondholder will want to be compensated, and the compensation is in the form of a higher yield. So in order to take on call risk, investors need additional reward in terms of a higher yield. Generally, when we calculate a yield on a callable bond, we calculate the yield to worst, which is the lower of the yield to maturity, and the different yields to call for the possible call dates. Now, when we calculate the yield to maturity, we're making the assumption that all cash flows are reinvested at the yield to maturity. Much like the internal rate of return assumption in capital budgeting. The yield to call, similarly, we're assuming that any of the cash flows from the bond will be invested in the yield to call. Again, we're assuming a flat yield curve, and we're making a fairly bold assumption that the yield curve is flat. It rarely is flat. We're also making an assumption with the yield to call that the investor will hold it until the call date that we are assuming. And we're also making the assumption that the issuer will call the bond. When we think about callable bonds, an issuer will want to call in bonds when interest rates are low because they want to turn around and issue another bond at a much lower rate. But this is not a costless operation. It is not costless to call in a bond. It is not costless to issue a bond. So there's more to it than simply looking at interest rates. There's going to be basically cost of transacting in terms of buying back the old bonds and cost in terms of floating a new issue. So that has to be considered too. So it's not simply a matter of looking at interest rates and when they hit a certain level that, everything's going to be called. It's not going to happen that way because you have to introduce the possibility of cost to this and part of the decision. So very often when we calculate yield to maturity or yield to call, we're making unrealistic assumptions. So we need to modify that a bit to do something more realistic. Now, in terms of the price-yield relationship, if we have a non-callable bond, what we find ourselves on that green line between A and A prime, and that has positive convexity, and we're familiar with that from our prior work. For a callable bond, what happens is when your interest rates are falling, there is some point, in this graph it's Y star, where the likelihood of the call becomes significant, and therefore the price of the callable bond will not rise to where it would be for a similar non-callable bond. So what you see is that veering off, if you will, and that veering off for the callable bond is a negative convexity. So a callable bond, if we look at their price-yield relationship, it's going to exhibit properties of positive convexity over some yields and negative convexity over others. Now, generally we look at that Y star point as being a comparison between general market interest rates, or that creditworthiness of the bond, so similar rated bonds, and compare it to the coupon rate. Because the coupon rate is relevant when the company's issuing a new bond. So if they have 8% bonds outstanding, and market rates fall to, say, 4%. This means that they could call in the 8% bonds and issue 4% bonds. And you might think, well, anytime it falls below 8%, but that's not necessarily true because of the costs of actually performing the call and reissuing the bonds. It's difficult to tell before the fact, though, whether that's, if rates go to 7% or 6% or 5%, where the issuer will actually call. What we know is that call is more likely the lower the rate. Now, if a call is unlikely, then there will be a convex price-yield relationship. Now, this is true, for example, the bonds that have been issued in this low interest rate environment. Interest rates have remained low. These bonds were issued when the interest rate was low, and they're going to exhibit a convex price-yield relationship, because generally interest rates won't get any lower than they are. So we're basically, any callable bonds with these low interest rates are going to exhibit properties most similar to a non-callable bond at this point. But in normal interest rate environments, we'll see something like the prior graph where we have that negative convexity. So what we've got is when market rates decline, the likelihood, the probability that yields will decline further, and the issuer will call the bond, it increases. So where that point is, we're not sure, but it's going to be some level. And that's what the graph is illustrating. That negative convexity means that when interest rates go down, price appreciation will be less for given interest rate change. So we have that dashed line on that prior graph. So a bond that is option-free will exhibit positive convexity throughout the price-yield relationship. A bond with an embedded option will exhibit positive convexity and negative convexity. However, the lower the coupon rate, such as bonds issued now, the less likely that interest rates will actually fall below there, and so we may never see the realization of the negative convexity for very low coupon bonds. Now, can bonds trade above the call price? Absolutely. Companies are not necessarily going to call them in. They may not have the cash to do so. They may not have the ability to go out into the market and refund, that is, buy the bonds and issue a new bond simultaneously. They may not have that ability. There are certain economic environments where it's very difficult for a company to issue additional bonds. So it isn't necessarily true that the call price is a ceiling on the value of the bond. In fact, many corporate bonds trade above their call price. Now what we can do is look at the value of a callable bond in terms of its components. And basically you can say, look, a callable bond has kind of a straight bond or non-callable bond as part of it, and then we make an adjustment for the fact that there is that call option. Another way of saying this is that every callable bond has two components. It has the non-callable bond component, that is the coupon, expected coupon and maturity, but then the investor is selling the issuer a call option. Call option simply means the right to buy something. So the issuer has the right to buy the bond back from the investor at a specified price, maybe at a specified time period, so that the issuer is buying that option from the investor, or turn it around, the investor is selling that option to the issuer. So the issuer owns that option. So when we look at it this way, think about a callable bond. You've got the basics of a non-callable bond, but then you've got the option that's sold to the issuer. So we calculate the callable bond price by considering the non-callable component, and then we subtract the value of the call option that the investor sold to the issuer. Now, the investor actually doesn't sell the option to the issuer, but it is analogous to that. So we can think of these pieces, and looking at these pieces help us value this bond with a call option, because what basically we can look at it in terms of cash flows as if it was non-callable, and then look at that value of the option and then come up with the call price. Now if you look at a callable bond, similar graph as before, if we look at a non-callable bond, it has the same features as the callable bond. The only thing different is one's callable, one's not. You see the A to A prime, that's the curve with the price-yield relationship for the non-callable bond. Then for the callable bond, we have that veering off as the interest rates fall, veers off, and that price appreciation is approaching that ceiling there. And so at a given interest rate, we could look at the difference between the price of the non-callable bond, that's the P and CB, and the price of the callable bond. The difference between the two is the value of the option. So that vertical distance between those two dots on this graph is the value of the option. Puttable bonds work the same way. In the puttable bond, the bondholder owns the option. So they have a valuable option. They have the right to sell the bond to the issuer, so they own a put option. So we can think of the price of a puttable bond as the price of a non-puttable bond plus the value of the put option, and that gives us the puttable bond value. So you have all the benefit of a regular straight old bond, and then you have the value of that option to sell it back to the company. So that gives you an additive relationship. So comparing the puttable, which is the top line here, with the callable bond, we see that relationship, that to get the value, we're dealing with a valuable bond without an option, and then it's simply adjusting for the value of the option. And that's our task at hand, is how do we value that option? Because that's we know how to value a bond, and so we want to value the option, and so we can come up with the value of a bond with an embedded option. Now, in terms of valuation models, well, you're familiar with the theoretical spot rate curve. We're going to be using that. But we also, with an embedded option, have to consider interest rate volatility. And that gets us into the messy territory of interest rate lattices, which we will look at, not in this lecture, but in later lecture. Now, there are different models we can use. We can develop a model with a bond that can be exercised more than one time over the life of the bond. Or we can look at the case where the option can only be exercised once. Or we can look at a model where, like a mortgage-backed security, where you've got prepayments coming in, dribbling in over time. You've got the possibility of partial payments, and you've got possibilities of curtailments. Now, in valuing an option-free bond, I'm just going to review a bit about the arbitrage-free pricing of a bond, which we did in much earlier chapters, chapter 5. But just to review this, if we value a bond using the shape of the yield curve, what we would do is we have the different yields to maturity, and from that we can estimate the spot rates and we can estimate the 1-year forward rates. So we start with our observed yield curve, and from that we develop the spot rate curve and the forward rate curve, which we've done before. When we value the option-free bonds, we can do it using the cash flows as zero coupon rates, and this is the basis of the spot rate curve. So we would discount each cash flow at the appropriate spot rate for the appropriate periods. Or equivalently, we could discount the cash flows by the forward rates, in which case we would look at the different forward rates and compound them in the denominator. Now what you see is, if you were to take, like looking at the second item in the last equation, 5.25 divided by, and you've got 1.035 multiplied by 1.04523. Well, if the product of those two is the 1.0401 taken to the second power. So you can use the spot rate curve, or you can use the forward rates. They are equivalent. And that's by definition. So the next thing we're going to do is look at interest rate lattices and how one values bonds that have embedded options. And we can use the interest rate lattices, which uses the principles of the static spread and the arbitrage-free pricing of bonds. Those combined to value bonds.